Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for February 1st, 2021. Please see our disclaimer for some very important information. Well, we certainly do have a lot to talk about this week as we enter the second month of the new year. We had a little bit of turbulence in the market last week. We can talk about that. Kind of the headline there is going to be GameStop, and have a few thoughts on that. But as we kind of look at the week in the indices, the Dow Jones was down about 3.3%. The S&P 500 was down about 3.3%. Nasdaq was down 3.5%. The Russell 2000 was down about 4.4%, and that's the worst drop that we've seen since the end of October. And we got a little bit of economic news. The economy, or GDP, rose 4% in the fourth quarter, which meant that we kind of closed out the year with a net 3.5% loss in the economy, which on an annualized basis, which is a lot better than anybody would have expected back in March, to be perfectly honest with you. I mean, the fourth quarter number was a little bit below expectations. I think the headline expectation was around 4.2%. And, just from a headline standpoint, let's see, we've got the announcement of the J&J vaccine trial data, and it showed overall a 66% efficacy rate. And it did prevent severe symptoms in 85% of the patients, which, I think in and of itself is a net positive. But I think some people, particularly in light of what the efficacy rates on Pfizer and Moderna, above 90%, getting a 66% number on the one-shot vaccine was not particularly exciting to some people, although I happen to think that it was a good announcement. But as you look across the spectrum, and then there's some other there's some other economic data we can talk about too. But the best performing area of the market, one of the best performing areas of the market this year has actually been emerging markets. We've seen a reduction in the dollar, kind of helping to fuel that towards the end of last year, and even some staying power, even as the dollar's kind of picked up a little bit here year to date. But having said that, the MSCI EFA, which is kind of a broad international index, was down about 1% over the year to date, which compares with down negative 1.1 for the S&P 500 and -2 for the Dow Jones. So international markets are holding up okay. Emerging markets for the year are up about 3%. Volatility, certainly as of last week, has picked up in the markets, and we'll talk about that in a second. But volatility is up about 45% year to date, and it was up quite a bit, 65% in 2020. Bonds, year to date, the Barclays aggregate index is down about 0.7%. It was up 7.5% last year. So a little bit of, as we've seen, kind of a picking up in 10-year rates. In fact, the 10-year Treasury is 1.07 as of the end of last week, and that's up year to date about 15 basis points from where we ended the year. So January certainly saw an increase in interest rates, as maybe some of these inflation expectations are being kind of put into the mix, so to speak. So we talked about bonds. High yield is actually up a little bit this year, and spreads have really come in, and they actually continue to remain extremely tight. High yield spreads year to date are basically about flat, and where they were at the end of the year, which is extremely tight. We talked about this in the charts of the week, and we've got several things on this over the last several weeks to kind of talk about that being a barometer perhaps for some froth in the market. But real estate, the real estate index is down slightly, about 0.3% year to date. MLPs, which is energy, energy's actually been been one of the ironic strong points of year to date. And I do think that there's groundwork being laid for higher energy prices this year. Certainly, an input into that is the cancellation of the Keystone Pipeline, which was announced after President Biden took office. But let's see, looking at hedge funds down a bit. And then crude prices are holding steady in kind of the low $50 range. So crude is up about 7.6% year to date. Gold is kind of holding in a range. It's about 1847 as of the end of last week. It's down about 2.5%, but again, it's trading in a range. So I think it's kind of holding a little volatile. One of these days, I'm going to probably include Bitcoin on the weekly analysis, but right now it's just in stratospheric levels and just so volatile. It's kind of even hard to talk about in the backdrop of these other more conventional measures. But I mentioned the 10-year Treasury high yield is up about 13 basis points in yield in the year to date. And let's see, we had a little bit of slowing in consumer spending, which I think we kind of expected. This is in the fourth quarter, kind of some of the data that we saw at the end of last month. And but a real bright spot, and we talk about this in the charts of the week, but business investment was exceptionally strong. And we continue to see strong performance out of durable goods shipments numbers and order numbers, so on and so forth. Really solid private sector growth. Consumer confidence, we saw in the charts of the week some sentiment numbers that are coming back up, which is positive. Again, they're really, well, they're considerably below where they were last year, but they're up off their interim lows, which is a positive sign. So basically, we kicked off the new year on pretty solid footing. Both the University of Michigan and the Conference Board readings for January were positive and witnessed an uptrend. That broad uptrend since the April plunge is still in place. But as we kind of look at the market, it was a pretty broad-based decline last year. All 11 sectors dropped, and 5 actually dropped by more than 4%, including there was a couple that actually dropped more than 5% just for the week. And some of these counter-intuitive areas like utilities and real estate, were down, but they were down the least. But volatility itself was elevated, as you might imagine, at 33. And we're going to talk about GameStop and whatnot, but the whole notion of, I think the risk of interest rates rising kind of puts equities in a bit of a box, and it puts a lot of pressure on earnings to help equities continue to go up. So with volatility being a little bit elevated, which frankly I was expecting, and some people may feel that that's a pretty a basic sign that we're seeing a bubble that might be preparing to burst. There are some kind of read-throughs that I think are worth paying attention to. Not that I'm ultimately scared, but I do think a correction of anywhere in the 5 to 10% range near term makes a lot of sense in this market. We've had a lot of retail investment impetus, and this is part and parcel to the whole GameStop issue last week, where they're piling in with leverage. We've had spikes in trading volume and kind of this almost euphoric sentiment level. And that's very symptomatic of, this bubble being pricked and, historical bubbles being pricked. I mean, this is kind of what happens. But earnings have really been strong. And it's funny, last week we spent all week talking about these short sellers being squeezed, but we didn't really say that much about earnings, and earnings have actually been really strong. But, and cyclically oriented companies like energies and materials and even the financial sector, I mean, by and large, are pretty optimistic. So there's some takeaways amidst this, uncertainty, if you will. But we've got a cyclically recovering economy. We've got an awful lot of liquidity in the market out there, and we have low interest rates. And I think, for as long as interest rates remain, low in the aggregate, I think there's room for stocks to grow. If interest rates move higher, that could be a real red flag that we're going to have to watch. But, we've had some kind of thematic stocks or story stocks, so to speak, that have had really strong growth. We've had a lot of IPOs, we've got a lot of, benefit and a lot of strong performance out of kind of these old economy stocks. And so, as I mentioned, there's a lot of retail investment, even retail investment in options, which is really kind of a rare development. Options are typically the domain of institutional, more what we call informed investors, but we've seen a real big spike in these small contract volumes for calls and puts, mostly calls, but that's an indicator that you're getting this, the retail investors trying to chase that caboose of the train that's pulling out of the station. And then we've got a lot of early investors that are, kind of wreaking havoc on some very notable stocks. But so, GameStop, this is the poster child for what happened last week, although there's certainly other stocks that were involved, AMC theaters, and Bed Bath and Beyond, or just a couple of other notables. But basically, when you talk about, like, look at GameStop. I mean, obviously they've closed about 1,000 stores in the last year, basically 20% of their base. They went from a revenue of like just under 10 billion to half that, and they lost money last year. And the last time they had, meaningful net income was, almost 10 years ago. And, and this whole notion that people, like my son, for example, I mean, they download games. They don't go to a store anymore. And so this whole business model of GameStop has really eroded. Well, as a result of this, here's a stock that has about 70 million shares, and the float, which is kind of the shares that are not tightly held, that are available to trade in a more liquid fashion on the market, is just a mere fraction of that. But yet there were over 70 million shares that were sold short, which means in some cases people that have sold shares to other people short were then lending those shares out. So you had basically shares that were loaned twice in some cases. So that's just the oddity of all of this. But so that, I mean, that's just kind of the odd backdrop on that. But I mean, and what happened really? I mean, just to kind of put in context. Well, in a weird and kind of almost sadistic turn of events, it's the little investor rising up against the institutional investor, and so basically you had some of the most widely shorted stocks. And what does that mean? That means that somebody is borrowing a stock to sell it in hopes that it will go down, the price will go down so they can buy it back to close out their loan and make a profit on that. And so now these retail investors in these chat platforms like Reddit, where there's high degree of organization and planning and plotting, allow retail investors to congregate and kind of look at some of these things, and so that's in many respects that's what's happened. So and that against the backdrop of kind of this whole evolution and rise of the retail investor, we've had a huge increase in retail trading during the pandemic. Brokers in the U.S. have added 10 million new retail trading accounts. We've got zero trading commissions, and the retail share of total volume continues to increase. And retail being like you and me trading for our own accounts, and that's now 20% of daily volume, and that's come up considerably, especially over the last 10 years. But like I said, there's more use of options in this, and trading in options has doubled in the last year, and small buyers account for basically double the volume of the big and the mid-sized players, and that's a really new evolution. All that does is inject more potential volatility into the equation. And there's a lot of liquidity out there, and like I said, there's these platforms like Reddit that allow small investors to congregate, to share information, to chat, to coordinate, so on and so forth. And then you've got these platforms like Robinhood that allow them to do that. But basically, looking at this. This is in Barron's over the weekend. The most shorted stocks in the Russell 2000 are up about 80% since October, and the least shorted ones are up about 20%. And the ones that have been targeted lately are like basically some of the most shorted stocks out in the market, and they're the ones that are exhibiting the most gains. Highly volatile environment. So call it boredom, call it the joy of making profits and wreaking havoc on the market. But there's a lot of some of the platforms like Robinhood, et cetera, have kind of curbed some of their some of the trading in certain stocks. I'm not sure I agree with that. I tend to favor more open markets. But needless to say, this is going to be something we're going to be talking about for some time. And I'm not sure that this short squeeze issue has kind of fully played itself out. Now they're rotating to, silver. So the silver ETF is now engaged in a lot of retail buying frenzy. But at some point, the music stops, and you got to find your chair. And if you don't have one, I mean, in that sense, I think there's potential for air pockets in a lot of these stocks that are running up crazily right now. But so enough of that. We'll probably circle back to that at some point. But some quick economic comments here. Fed Chairman Jerome Powell, continues to be very dovish in what he says. He's basically reaffirmed the Fed's commitment to remain really accommodative, and even after we're reopening after the pandemic here. And that there's, I think, laying out, and the other thing too, which we're going to have to watch, is they're laying out their expected timeline for tapering these purchases of assets in the open market, which has been fueling this liquidity and helping to keep interest rates low. Back when Fed Chairman Bernanke, during the initial quantitative easing periods where the Fed was buying a lot of these assets in the open market, when he articulated a desire to stop buying as much, or stop intervening as much, we had what we called the taper tantrum, and that sent interest rates up, in a pretty big way. And I think certainly Fed Chairman Powell wants to not have that happen. We certainly don't need a spike in interest rates. I guarantee you that would not be good for the equity markets. So I think being very careful about positioning statements and things like that on when the Fed is going to begin to taper some of their asset purchases is going to be critical here. So let's see. Other economic data. I talked about earnings, gains, and initial and continuing job claims, jobless claims, I should say. So we're staying over 800,000 on initial claims. Continuing claims are kind of holding in there, about 4.8 million. I'd say we continue to get great data out of the residential construction area, and we certainly need it because inventories for sale in the open market are very, very low. Residential construction was up 14% in the fourth quarter. And then I already mentioned durable goods orders have been exceptionally strong. So, and then, in terms of the economic recovery, obviously we've got the pace of vaccine distribution, which is, we're up to 25 million shots in arms now. In our charts of the week, we kind of talk about our pathway to getting to that full, that herd immunity, and we're not even halfway there. So we still have a ways to go. We've got the executive order from President Biden pledging 100 million doses in 100 days. If that does execute as planned, that's going to be beneficial. And concerns over, case numbers, hospitalizations, and deaths. And we certainly know that there's the 7-day moving average of coronavirus cases is rolling over, which is good. But when we have this vaccine rollout and it gets more effective, then you're going to have a little bit more confidence. However, I think it is becoming a little bit apparent to all of us that perhaps the coronavirus environment may stick around a little bit longer than expected. And so, what this means is that we're going to have a lot of confidence in our ability to get through it. And we certainly need a lot of confidence from the business sector. We need confidence from consumers to keep spending. And but I still tend to definitely favor, the same areas that I was favoring previously. Small caps, certainly, and constructive on international and particularly emerging stocks. I think the dollar is going to remain lower, and that's going to help exports for larger companies, companies of quality, certainly ones with cyclical exposure, and then certainly some of the areas that have been kind of left by the side here during the pandemic. So economy, we just talk about that really quickly. I mean, we've been talking about it, but I mentioned business investment. I cannot underscore how important that is. And then the home building side, we know that investment in industrial equipment is already above pre-pandemic levels, and that's good. So we've got a lot of spending in healthcare, in the office sector, even though people are officing at home. So and we've got a lot of savings. So basically, whether it's government transfer payments or less consumption on the part of, perhaps middle and higher income earners, we have an extra 1.6 trillion in savings. And there's a really nice chart in the charts of the week this week that kind of highlights that. I think that provides a lot of dry powder for consumer spending as we head later into this year, especially if there is that confidence factor that I just mentioned about the virus deployment and getting shots in arms. If people feel like that's happening, they're going to be more motivated to open up their pocketbooks. But having said that, the risk is, as we still kind of study the B351 variant that's coming out of South Africa, and the B117 variant, which was in the UK, and then there's a third variant. And I guess as we're seeing these variants come, these virus mutations, we're not quite sure what that's going to do to that bar that we need to reach for herd immunity. So, that's a risk factor that we'll need to watch. Interestingly enough, and the International Monetary Fund is now forecasting global GDP growth of about 5.5%, and that's up a little bit from their October forecast last year of 5.2. And China was the only major economy to grow last year, but IMF predicts the U.S. economy will grow over 5% this year, which is probably the largest number I've seen and then based on low inflation, stimulus, and basically diversified economies to help to help bolster that. But they also say that basically 90 million people globally are expected to fall into extreme poverty in 2021, which reverses a lot of the progress that's been made over the last 20 years. But so let's see. I'm not sure that there's much of anything else that I want to say, other than we're going to continue to monitor. We're going to continue to monitor the volatility that's stemming from, these retail investors, and we're going to continue to monitor the impact of what this retail investment in the market is doing and where it's going, because these are people that are deemed to be less in the know, if you will, or less sophisticated in investors, but they clearly are making more of an impact than they have, and so being a force to be reckoned with, we need to take stock of what they're doing. Earnings continue to be positive. I think the statements coming out of CEOs are uplifting. I don't see a lot of negativity there. Certainly the technology stocks that reported last week had some really good reports. And so, I feel good about that. Again, I feel good about, the bets that we're transitioning to for the new year. Certainly the near term, the volatility that we're seeing has been largely expected. And if we have a correction, it just provides a better buying opportunity. Again, there is, I think, room for stocks to go higher. I think there's room for bonds to perhaps go lower. But if you stay short on your maturities, you're smart in that regard. I think you'll be well positioned. And as long as you're not struggling for yield as much, because even the most high yield and the least credit-worthy bonds out there are, because of these really tight spreads, they're not yielding very much anyway. So it's a waiting game to get through this period, but I think with greater clarity on the virus front, it's going to provide some feedstock for a more protracted improvement in the economy over the next several years. And I think the economy can improve, and stocks, there's still a pathway for stocks to expand based on improved earnings, even with the potential for interest rates to migrate higher. What we just need to avoid is a shock where interest rates move higher in a really short time frame, and expectations for inflation suddenly bubble up. We want to avoid that. But all told, we'll continue to monitor these developments, and I hope you have a wonderful week. Thanks for listening, and the information you see on your slide here, feel free to reach out. We'd love to hear your questions, comments. Stay safe, have a great week, and we'll talk to you very soon.